Derivatives might sound complex, but think of them like different ways of renting property. An option is like paying a small fee to secure a unit in case you want it later. A perpetual is like a flexible co-working membership with no fixed end date. And a structured product is like striking a rental deal where you lock in lower rent upfront but agree to certain conditions. Different structures, same idea, tools to manage costs, risks, and opportunities. In this video, we'll break down the three most common derivatives, options, perpetuals, and structured products. What makes them different, and how to decide which one might be right for you. Before we dive into the different types, here's a quick recap on what derivatives are. A derivative is just a contract whose value comes from another asset like stocks, commodities, or digital assets. They exist to help people manage risk or create opportunities when markets move. If you want a deeper dive, check out our previous video. What exactly are derivatives? And why do they exist? Now that we've got that foundation, let's break down three of the most common types you'll actually see in crypto: options, perps, and structured products, and figure out which one might be right for you. Imagine you want to rent a shop space in a busy mall, but you're not sure yet if your cafe will be ready. You pay the landlord a small non-refundable fee today to secure the right but not the obligation to rent the unit at $2,000 per month starting next January. If by January, rents in the mall rise to $2,500, you're in luck and you still rent at $2,000. If rents fall to $1,500, you can just walk away, losing only your small fee. That's like an option, locking in a price, with the flexibility not to commit. Now, think about a co-working membership or a flex rental in a serviced apartment. There's no fixed end date, which means you can stay indefinitely. But the rent is floating, meaning to say it adjusts with the market. If the neighborhood gets popular and demand spikes, your monthly rent could go up. If demand falls, it could go down. In trading, that adjustment is called the funding rate. Think of it simply as a small balance payment that keeps prices in line with the real market. That's a perpetual, ongoing exposure, priced continuously to stay close to the market. Now, imagine a landlord offers you a special deal, $1,500 per month instead of $2,000, but only if you agree that even if market rents fall below $1,500, you'll still pay $1,500. In return, you lock in cheaper rent upfront, but you give up some flexibility if the market drops a lot. That's a structured product. You trade some what-if scenarios for steady, predictable savings or yield. On ProdigyFi, this is exactly what dual currency investment vaults do. We package options into simple vaults so you just pick your asset, target price, and date. And like the rent deal, you secure predictable yield regardless of how the market moves. So which tool fits you best? Options are great if you want flexibility and controlled risk, just like Prodigy's Sally. Perps, on the other hand, are perfect for active traders similar to Prodigy Bob, looking to speculate on price moves. Lastly, structured products are designed for everyday users who want yield opportunities without needing to build complex strategies. At the end of the day, derivatives aren't about making things complicated. They're about giving you choices. Whether you want flexibility, unlimited exposure, or a simplified package, there's a tool for you. And with platforms like ProdigyFi, structured products are no longer just for Wall Street or high net worth individuals. They're accessible, automated, and built for crypto users like you.